Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi there and welcome to the Better System Trader podcast. I'm glad to say we are back. And I'm sure you've realised things have been very quiet at BST the last probably about 6 months or so. We've only released a small number of podcast episodes. And that was because I took a little break from podcasting because I needed to focus on some other trading projects. But now I'm excited to announce that we're back and I can't wait to share this new podcast episode with you. Now, our special guest for this episode has done some really interesting work into strategies that manage trading strategies. This can have a huge impact on trading performance, but what does it actually mean and how can we do it? Well, David Bean from Capstone Trading Systems is joining us to explain exactly that. Plus, he's going to share a whole lot more with us, including patterns versus indicators, where they fit in a strategy and which works better. We're also going to talk about market regimes. Why they may not be the best approach, and an alternative solution that could be better for you. We're also going to discuss how to really dig deep into understanding how a strategy and market truly works and the benefits of knowing that. And we'll also talk about how to determine the best time to start trading a strategy and when to stop trading it. Plus, towards the end there, we talk about how to plan for, manage, and even profit from strategy degradation. Plus, we do cover a whole lot more. So enough of the delays. Let's jump now into my chat with David Bean. Hi, David. Welcome to the show. It's really great to have you here.
Thank you. Thank you for having me.
So how about, to get started, we just have a little bit of chat about your background so that people can get to know you a little bit better. So do you just want to share a little bit of your background and how you got started in trading?
Yeah, absolutely. I have an electrical engineering degree, started out, and that was my original career, was electrical engineering. Started in 1995, January. Did that for about 6 years. Didn't really think that was what I wanted to do long term. It's a great profession, but was interested in something different, something more dynamic, like the financial markets and trading. I started studying that. While I was in engineering, I traveled a lot and had a lot of time to study the markets, study trading, begin system developing. And so a lot of the analytical skills that I had in engineering carried over to the research for development, trading system development.
Yeah. So if we look at the type of trading that you do now, can you give us an idea of the markets that you like to trade, any particular styles that you gravitate towards?
Yeah, the markets that I trade mostly are the stock index futures. I also like to trade gold. I like to trade crude oil. Those are probably the four main markets. Euro currency as well is another market. The styles I like to trade are mainly day trade strategies, very short term, combination of trend, mean reversion, counter trend. Some strategies are swing trade as well, but short-term swing trade. So I'm very short-term focused.
Yeah, so it sounds like you're quite selective with the markets that you trade there. Was there any particular reason why you selected those markets over others, or something that drew you to those markets?
Well, they're the major markets in each sector, really. You know, crude oil is the major market in the energies that has the most volume, has a good price movement. Gold has the most volume in the metals, has good price movement. And the stock indexes, even the S&P, even the NASDAQ, those are good markets to trade. They go through periods of time where ranges are narrow, but then you go through periods of time where there's ranges that provide good movement. And of course, the currencies. The euro currency is kind of the prime currency to trade, just based on volume and ranges.
Yeah. I was going to say, because your focus is mostly on short-term intraday strategies, you obviously need to take that into account and select markets where the opportunity is there to trade that type of style? Because there are some markets that don't, that style doesn't fit. So that must have been something that you considered as well, right?
Absolutely. If you take, for example, the major market in each sector and you test a strategy, you might have a profitable strategy on the major market, while the minor markets, for example, if you look at the grain complex, something like soybeans, you might have a strategy that works well in soybeans, and it doesn't work as well in maybe corn or wheat, because those daily ranges aren't as big as the dollar daily ranges that are in soybeans.
Yeah. Now, you said there that you trade lots of different trading styles. So where do you get ideas for building these strategies when you're mixing styles together?
Well, you spend a lot of time watching the market. So, you're spend a lot of time scalping, sim trading, and discretionary trading as well, to get a feel for these markets. Instead of just looking at static data, you watch the markets all day, every day. Watch the order book, and you study tendencies. And when you spend a lot of time with the market, you sort of develop this relationship with the market, where you know the market pretty well, and then you get ideas and you test those ideas based on what you saw intraday. If you see a repeating pattern, you say, "Wow, I remember seeing this several times. Does that repeating pattern actually have validity long term, or is it just something that I've seen over the last few days? Does it work for 3, 5, 10 years, or is it just a 3-day or 1-month pattern that I'm seeing here?"
Yeah. Okay. So if you say you decide you want to start building strategies for a particular market, how would you approach that from the point of view where you said you like to watch the market for a while, try and day trade it? Can you give us some more specifics around what you would actually do there to start working in another market?
Yeah, you would watch that market, for example, and then you would use what you know from other markets, typical tendencies and patterns, to trade that market, maybe on a discretionary basis, the very small amount, to get a feel for that market, to get strategy ideas.
Yeah. So how long are you, when you say you watch the market, how long are you talking? Are you saying you just watch it for a couple of days or a couple of months, or how much detail do you need to go into to get a feel for something that might work?
Well, you typically watch a market for a few months. If it's a new market, I guess you would say, for example, cryptocurrencies, I guess, would be a new market. It's difficult to go into a new market when you're watching all these other markets too, and it's hard to do too many markets at once, and so it'd be very selective in how many markets you can watch in any given day. But if you're selective, you might want to watch a new market for a few months, before you get a feel for it.
Yeah. Yeah. And something I've noticed as well on your website is that you use quite a few different chart durations, like 15-minute and 60-minute, but then you also get down to the lower time frames, like 1 minute, and I think I even saw 15 seconds in there, which is quite short. So are there any differences in how you work with the shorter time frames versus the longer time frames?
Yeah, I mean, one of the reasons why I like to test it on 1-minute charts is because it's very granular, very incremental, and you can find more information on a 1-minute chart, whereas when you're working on a 60-minute, 15 or 16-minute chart, you're not looking for you're looking for more of a big picture approach, different types of patterns, so to speak.
Yeah, but do you find that there's different different like characteristics or behaviors between the longer term and the shorter term timeframes? And if so, how do you manage that?
Yeah, there are. A lot of my strategies are based on larger time frames, but then I build them on 1-minute bars for accurate back testing.
Right.
It depends on volatility as well. So if you're dealing with the volatile market, then you can go down to smaller time frames. But if you're dealing with a market that doesn't trade as much, then you trade higher time frames.
And what about across different markets as well? It seems that sometimes you use the same or a similar type of strategy on different markets. However, some markets can have different behaviors and characteristics. So is it is it actually important for you for strategies to work across different markets too, or is that just something additional that you like to consider?
Yeah, that's something additional I like to consider. Ideally, that's where you start. You want to find a pattern that works on all markets, all time frames, and that's pretty hard to do because like you say, each market does have its own characteristic, its own pattern. But you still develop on each market individually, and then you look for patterns that may work across different markets. And I think there's a lot of validity if you find a pattern that works on a broad range of markets for 10, 12 years. There's a lot of validity behind that, and it's rare to see that, rare to find that type of pattern. And so I still look for that pattern, and have found some patterns that do work in that work on that time frame, different markets across different time frames, but very few. And then you can get individual characteristics in each market. You can focus on those as well.
Yeah. So when you say patterns there, are you talking about mostly chart patterns and bar patterns, or do you also include indicators and other types of calculations in the strategies that you're building?
Yeah, I favor patterns more than indicators in my development, but I use both.
Yeah.
I use both, but I use patterns more than indicators.
Yeah. Do you find, is there a specific reason for that? Have you found that they're more valid or robust, or they work better, or what's the driver behind your decision to kind of lean more towards patterns and indicators?
I've just found more success in finding strategies that work based on patterns versus indicators. I'll still use indicators, but when I use an indicator to confirm something, it's just a very, usually the standard inputs for that indicator. It's not optimized. It's just more of a guideline, a confirmation for that as well. And so, I found that patterns tend to represent behavior based on my analysis more so than indicators, which are more mathematical in nature and can be more easily optimized and curve fitted.
Yeah. Now, some of the markets that you mentioned that you trade are 24-hour markets, or pretty close to 24 hours, and they can often have different behaviors during specific times of the day, perhaps in the the European session or the US session or Asia. And I noticed that sometimes you use custom sessions that have specific start and end times. When you're building strategies for these 24-hour markets, how do you actually identify the session times that you want to trade?
Well, looking at the volume, when there's the most volume, if you plot the volume on a 24-hour market, you'll see a window where the volume's the highest. And still, the electronic markets came into effect between 2006 and 2008 for a lot of the commodities, and most of the markets were mainly electronic from 2008 forward. But before that, you had pit sessions, and so a lot of the markets still abide by those pit session timeframes where the volume is, and so a lot of my custom sessions are around those old pit session times, and they also include volume. There's more volume during those time periods.
Yeah, so that's an interesting observation that you make, that even now that you're still using the pit sessions and you're having a lot of success with that. So I'm not sure if that's something that people would even consider these days with the electronic markets.
Yeah, well, the liquidity is pretty narrow in some markets overnight. The major markets, not so much. But yeah, the ranges, the price movement is bigger. When crude oil closes at 2:30 Eastern time, most of the time it kind of goes flat. You can see a lot of price action right into the close, and then most of the time it's pretty flat after that. And then during the European session, it can pick up.
Yeah. Something that I found interesting about your work and the content that you've published on your website is this concept of money management optimization. And I think it's an extremely valuable concept that perhaps people don't focus on too much. So if you don't mind, I'd like to have a chat to you about that for a couple of minutes.
Sure.
Yeah, cool. So, well, how about we start with the basics first? Can you explain what this concept of money management optimization is?
Yeah, I believe you're talking about my money management algorithms, or not optimization, but money management
Okay.
algorithms.
Yeah.
There is a tool, an optimization tool within that, but in general, it's the money management algorithms, and it's a tool that it can be a system that trades your system. So the money management algorithms, it looks at your system. It's a systematic way to determine when you should trade your system, if you should turn it off, if you should start it. And see, it looks at the equity curve, and there's different indicators that can be applied to the equity curve. And those there's different rules that can be applied, different combinations of rules that can be tested. It's something that I've always wanted to do, and it took me several years to put together when I first put it together. And so it allows me to test different ideas that I've always wanted to test about my system that would require very complex programming. For example, if you're going to turn your system off, how do you know when to turn it back on? Because the equity curve is not generating an equity curve anymore if it's off. And so you need a system to look at your system running while it continues to run, and then decide when you should trade it.
Yeah. So what actually led you to doing this research? How did you discover this idea?
Well, just the concept of, I saw someone applying a moving average. Trade your strategy if your equity curve is above its moving average. And so that, I don't remember, it was a long time ago, but I took that concept and thought, yeah, how would you test that in TradeStation or another platform, one of the trading platforms? How would you actually test that without exporting the data, putting it in Excel, and then externally testing when you start and stop it? And so with this setup, I'm able to test it in the trading platform and then automate it.
So that example you gave about trading the equity curve above a moving average I think it's been around for quite a while. I'm not sure where it came from, but from what I can see, you've actually taken that concept a whole lot further than just some of this basic stuff. Can you give us a basic example, perhaps, of the types of things or concepts that you've looked into that perhaps work well or don't work well?
Yeah, there's the moving average is one approach, the closed trade moving average, and then there's the open equity moving average. You can apply RSI, stochastic, ADX. You want to determine the strength of the trend. You can test some ideas such as stop trading if it goes into a drawdown, and then you can define how far of a drawdown, and then start trading if it goes back into a run up. You can do the opposite of that, which means to start trading when it's in a drawdown and then stop trading it when it's in a run-up. You can test the pinpoint entry algorithm is one of my favorites, because it always seems like if you get in a trade, the market there's always some deviation against your strategy, no matter what. You never just pick the exact turning point. And so is there a better way to enter this trade? So if I'm in this trade, should I start trading it when it's at a $50 loss, $100 loss per contract? Or, can I improve the entry efficiency with this entry algorithm? And so that gives you a lot of insight into your strategy when you test these things, to see how could you improve your strategy? How could you use this algorithm to improve your trading? Did you apply the algorithm, or what did you learn from the algorithm to then improve your strategy?
Yeah, that's interesting that you go right down to the level of execution of the trade and trade management, rather than just, I think sometimes these kind of trade your equity curve things, maybe assess it like every week or every day, but you've really taken it down to the detail of trying to understand your strategy, and that sounds like you've put in a lot of work to get there.
Yes, absolutely.
Yeah. So, it's kind of clear what some of the benefits of doing this are, particularly when you talk about, when to stop trading a strategy and when to switch it back on. There's all kinds of implications to drawdown there. But are there any other benefits that you've seen by applying some of these money management algorithms?
Yeah, I mean, you learn how your strategy works. You learn how the markets work, and so the benefit it can help you improve your strategy as far as the entry efficiency. And then you learn, wow, my entry is not as bad as I thought. If I wait to get in when it's against me, then I'll miss the trades that were really good. And so you learn a lot about trading and trading systems when you test these ideas that are in general harder to test. Because imagine if you have a strategy and then you try to reroute the strategy so that how do I get in at a better price once I'm in? Then you have to somehow mark that entry point in your code and then re-enter at a better price, still using all the stop losses and profit targets or exit techniques based on the original entry price. And so you end up learning a lot about strategies and system trading when you do that. When you test it against the entry, you learn that the nature of different strategies might work better. Some strategies might work better. Say, for example, counter trend strategies might work better waiting for a drawdown to start, or strategies that, say, for example, a strategy has 40% winners. You might wait for a drawdown to start. A strategy that has 40% winners is one of those strategies, or 30% winners is one of those strategies that typically it has a tight stop loss, relatively speaking, to its exit. And so a strategy that cuts its losses quick and lets its profits run typically has a lower percentage of profitability. And so taking a strategy like that with low percentage profitability and waiting for a losing streak to start and then getting out on a run up is different than, say, for example, a strategy that has 70 or 80% winners. A strategy that has 70 or 80% winners, you might want to do the opposite. You might want to increase your position size as it's winning.
Yeah, that's really interesting actually, because it's kind of, it might seem counterintuitive to switch a strategy on or even start trading a new strategy when it's going through a period of perhaps underperformance. And I think a lot of people like to see a strategy that's making some money and performing well before they might switch it on. So I think, as you mentioned there, just digging deeper into this kind of stuff and testing these things really gives you a lot of insight into the nature of a strategy.
Right. A lot of people don't want to trade strategies that, are 30% win 30% of the time. Most people want to trade strategies that make, retail traders in particular would rather be right 70 or 80% of the time than 30% of the time. And so it can be hard psychologically to sit through those drawdowns. So taking strategies that go through losing streaks, longer losing streaks, or lower percentage of profitabilities, and waiting for a drawdown to start them, because those strategies usually do well during a trending phase of the market.
Yeah.
And we know that markets trend less than they counter trend or chop. And so you're basically sitting out, waiting for it to take its series of losers. And as long as its drawdown is in line with previous historical drawdowns, then you could have a good starting point when it's gone through a set of losers first before jumping in at an equity peak. You probably don't want to jump in at it. A lot of traders do jump in at equity peaks, but you don't necessarily want to jump in on an equity peak on a strategy that only wins 30% of the time.
I think as well, a lot of traders like to use market regime filters. So if they've got a trend following strategy, they might want to switch it off when the market stops trending. Have you done any research into do market regime filters tend to be more effective than trying to get it at the equity curve level, or vice versa? Or what are your thoughts on that?
I find it hard to define it. It just the regime filters that I've worked with they seem to be too delayed. The delay factor is too great, in my opinion.
Yeah.
And so I do better with this.
Yeah. Now, I think people listening to this are probably wondering about the dangers of over-optimizing or potential dangers of over-optimizing money management rules. So, for example, if you take the first example you mentioned about the moving average, do I use a moving average of the last 20 trades or 50 trades or 30? Is there any dangers in over-optimizing these rules? And if so, how do you even approach that?
Well, absolutely. You don't want to add too many rules. If you have a strategy that has, 5 or 6 rules already, which is quite a lot, and then you add 3 or 4 different money management algorithm rules, you can over optimize it. But if you say, for example, have a strategy that has 1 or 2 rules, and then you add 1 or 2 money management algorithm rules, then, you're within the tolerance of the number of rules that you should have in a given strategy. It should be added to the total number of rules you have. And so I like to keep my strategy simple, and I like to keep my algorithm simple, and I like to use general algorithms that I've seen work on other setups as well, on other strategies, not just one-off strategies, not to have a different algorithm for each system, but try to have a standard set of algorithms for each for a group of systems.
And when you're testing these money management algorithms, do you like to split it into in-sample and out-of-sample periods, or do you have any other techniques you try and use to validate the potential robustness of that algorithm?
I do. I test it, and then I watch the out-of-sample for a period of time to see what the results are. And so I like to see good out-of-sample performance.
Yeah. Okay. Cool. Now, something else I saw on your website was the term degradation algorithm, and I thought, wow, that sounds really cool, but I don't really understand what it is. Can you share a little bit about the concept of this degradation algorithm?
Well, you have to think about the concept that all systems eventually degrade. They degrade somewhat. I've had some systems that the equity curve improves, but most of them, they do about the same, or they start to degrade at some point. Every system is going to go through worst case drawdown, or every system will stop working at some point. The market will change, and there'll be market patterns that no one could have anticipated. And then so you have to make a change to your strategy. And so I don't know of a system that works forever. And so since the system degrades, the degradation algorithm focuses on the concept of a degrading system, and buys the dips in the equity curves and sells the rallies in the equity curve. And so the concept is instead of being optimistic and trying really hard, you get in this path when you first start developing that you're going to develop that one strategy and it's going to work forever, and you're going to compound profits, and everyone pulls out their Excel spreadsheets and says turns $5,000 into $1 million, and they found this perfect strategy, and then you start trading it might work for a while, and then it starts to degrade, and then your concept of it didn't work out, what you thought was happening didn't work out. So instead of getting frustrated, okay, now I'm going to really try hard this time, I'm going to really find it this time, I'm going to work even harder, and I'm going to find this perfect strategy. And so instead of looking for the perfect strategy and keep going through the cycle of trying to find the perfect strategy, you find a pretty good strategy, and you realize that you're always on the watch. That hey, it's probably going to degrade, and when it does, we know what to do. We know what to do. It's a better approach to take a defensive approach in your trading and anticipate the bad, instead of saying, yeah, this is gonna be the best ever, and I'm just gonna compound endlessly until I can retire or whatever,
Yeah.
So
yeah, I'm only laughing because I probably did that as well at the start, and I'm sure we all have. And
everyone starts out that way. You come into these software tools are very, they can lead you into some interesting design ideas that you don't really understand the implications of how markets change. And so, yeah, absolutely. We all start there.
Yeah, yeah. So when you're measuring you're measuring the degradation, are there some particular metrics that you're looking at to detect that?
Yeah, consistently I've found, starting in a certain amount of drawdown and then getting out on a run up while using the pinpoint entry algorithm that looks for the strategy to go, there to be some adverse excursion from the entry price. And so also I guess if you look at the moving averages as well as the average measure the average drawdown. And so when you go through this period of time where the strategy is going against you, if it's gone against you by a certain amount, you start, and then the entry goes against you, then you can start trading it.
So did you come up with that just by getting a feel for the market? And you mentioned at the start that you like to watch the markets and do a little bit of discretionary trading. Did you kind of get that idea from there or somewhere else?
Well, just just testing lots of money management algorithm approaches, and so there was the combination of applying this concept that your strategy will degrade over time, and it's better to be prepared and then maybe even profit from it.
Yeah,
be more pessimistic than optimistic when you trade.
Yeah, well said. So I just want to ask you one final question before we start wrapping up. Now, some traders would say that trading the equity curve or strategy performance works well in theory. I mean, there's software out there that can help you do some of these things, but when you put it into practice, it doesn't work so much. So what have your experiences been applying it to your own live trading?
Well, I would say that you have to manage your strategy somehow. And so if you don't apply it systematically with a money management algorithm or another tool like a money management algorithm, how are you going to manage your strategy? And so, yeah, I've have strategies that break down. You could say that at a worst case drawdown, you get out, and then you don't need a money management algorithm for that. But how would you test some of these other ideas? How would you maybe profit from a degradation in your equity curve? Sure, maybe simple moving average crossovers of your equity curve may not work. You may get whipsawed by your own strategy if it stops working, and you buy it when it's doing well, and then it turns and it goes down, and it's kind of like getting whipsawed in the market with a breakout strategy. That can also happen. So it depends on the approach you use, and so you have to have a way to manage your system. And if you can't do it systematically, then you're left with a discretionary approach. And so those traders that say that you can't trade the equity curve, then how do you make those decisions? Do you have a perfect strategy that continues to perform year after year, never breaks down without adjustment? And if you adjust it, how do you know when to adjust it? And so there has to be some sort of tool. Maybe they have the discretionary skill of seeing the market change and knowing exactly how to change their strategy. But there has to be something, the determining factor to determine when to stop or start your strategy.
Yeah. Well said. Thanks, David.
Sure.
Okay, now I just want to start wrapping up with a couple of quick closing questions.
Sure.
What's the biggest lesson that you've learned through trading the markets?
You have to have the truth. That the truth is the most important part of the markets. What is true in the markets? What should the market, not what the markets ought to be doing, but what are the markets actually doing? And also, what is true about your trading? How are you trading the market? Are you trading it? Are you truthfully trading it with something that works? And it's easy to miss that. You don't always know the truth yourself. You're in search of the truth, and sometimes our biases affect our truth. And so we have to get rid of our biases, know the truth, and be persistent in that.
Cool. All right. Well, what do you think is the most important ingredient to becoming a successful trader?
I think that persistence in the truth, like I'm saying, is you want to test those ideas. You have to be persistent finding the truth, because you might test 100 strategies before you find one that you really like. And that's typically the case. Most of the ideas you test aren't going to work, and a lot of times the opposite of what you thought works, because the markets are very contrary to human nature. So what you think works oftentimes does not. It's a very short-term pattern, and you have to be persistent in finding that truth as a trader.
Yeah. And what about trading books? Do you have any favorites that you like to recommend other traders?
Well, in general, I've always liked Reminiscences of a Stock Operator as well as Market Wizards. Those are classic books that present a lot of general trading ideas. And then there's specific books that I've read in the past with code in them, and those books I think are very valuable if you're a systematic trader and you want to find books with example coding. That's how I got started. Is I read other authors' books with coding ideas or specific rules, and then coded those. And so finding books with code, and then just general principle books like Reminiscence of a Stock Operator, Market Wizards help you with your trading psychology quite a bit.
Yeah. Okay, and if listeners wanted to learn more from you or get in touch with you, how can they do that?
Well, on my website, CapstoneTradingSystems.com, you can go through all the strategies there. You can contact me if you have any questions. I have books on Amazon as well. I've also published my own books with code in them. I think it's a very valuable tool, and I wanted to be able to do that as well, to have strategies with code in them that you can look at, learn from the examples. Most traders that I know learn by example, and so that's one of the best ways to learn is to learn from example. And I have a you can sign up for my email list on my website. I send out emails a lot of times with coding examples and market discussions and how to trade the current market.
Cool. I'll also link to those pages and books as well from my website so that people can find those easily if they're not in a place where they can search right now. So, thanks a lot for your time today, David. I really enjoyed our chat. Is there anything else you'd like to mention before we finish up?
Well, that's it for me. I appreciate the opportunity for you to have this interview with me. I appreciate it.
Thank you, and I'm sure all the listeners are going to find or have found what you've said valuable. So thanks again for spending time with us, and all the best.
Thank you, Andrew. All the best to you as well.
Cheers. Thanks, David.
Cheers.
Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.